We're going to talk here in this presentation about liquidity, the depth of a market for particular stocks. So what we're looking at is how much can we trade of this stock or general asset without moving the price. This is an interesting area of market microstructure. This is sort of a first step in market microstructure. One thing that is useful to know, and what we're going to do is frame the liquidity for a stock, the market depth, in terms of the amount of informed and uninformed trading in that market. And roughly speaking, the more informed traders in a particular market, the more the stock's price will react to trades. Meaning, if I'm a market maker, I always lose to informed traders because they only trade when the stock is mispriced. So if I think there's a lot of informed people, I as a market maker will move my bid ask in response to trades. Whereas if I think most of the people in the market are uninformed, I always, as a market maker, I always gain from the uninformed on. So I won't move my prices in response to trades very much. So what we're going to do is we're going to look at how to measure market depth, how to measure how much we can trade without moving prices, talk about that a little bit in the framework of informed and uninformed trading, and then we'll have an applied project at the end for students in my class that and for also anyone else out there. The data will be in the presentation, so you can download the data and estimate it yourself. This is market. So this is a small introduction to market microstructure, or maybe a first step. Market microstructure is a very interesting area of finance, and the nice thing about it is financial data is much more readily available today than it was 10 years ago. So the nice thing about market microstructure is any theory that we talk about, you can immediately jump in to the massive amounts of data generated in financial markets every day that is freely available. The part of that, the proportion of that data that is freely available, and start estimating these models. Last thing I'll say before we jump in is this presentation is available. The actual presentation is on GitHub, and then the code for this presentation is on GitHub. So I'll post a link to that. So a couple thoughts on private information and public information before we start estimating the sensitivity of price to order flow. Private information is, trades are the ways that private information is incorporated into prices. So if I have private information, again, this isn't inside information. This is just I know something relevant to the stock price that everyone else doesn't know. This could be due to my own research, what you will. But if I know something, then I'm going to try to trade in such a way to generate profits off of that. And by my own trading, that is going to incorporate information into prices. So basically, you can think of the market maker. So the market maker is the entity that posts bids and asks. Roughly, the job of the market maker is to earn that bid-ask spread. But the idea here is any trade that comes in, I try to figure out if they're informed or uninformed. If they're informed, I change my bid-ask. If it's a buy, I'll move my bids and ask up. If it's a sell, I'll move my bid and ask down. And if I think it's uninformed, then I won't move my bid and ask. But so the idea here is there's always some probability that it's informed. So as these trades come in, they're incorporating that information, that private information that I have, into the prices by me saying, well, there's 15% chance it's informed, so I'll move my prices up a little bit if it's a buy. Good. And that talks about that a little bit. So public information. Now, if the information is public, so you can think, for example, of earnings announcement. You don't need trades to incorporate the public information into prices. If I'm a market maker and a company beats its earnings, I can move up my bid and ask spread. So what we can think of is private information is going to be incorporated into prices through the trading of that person with the private information, and public information is going to be or can be incorporated into prices through simple changes in the bid-ask spread. So a very important paper in this area, one of the first papers in this area, is Kyle 1985. So what Kyle 1985 did is to say, okay, let's say there is a market participant with private information relative to the stock's price. So they know something everyone else doesn't. How will that person trade? What is the sort of trading rule? And I definitely read this paper, and there's a lot of summaries of this paper out there. So it's a very interesting paper. But roughly, the outcome of this is to say, well, if there's a lot of noise trading, then the informed trader can trade more without sort of being discovered. So the idea of this is the more noise trading there is, the more the informed trader will trade. If there's not a lot of noise trading, then the informed trader will trade less, meaning their trade will have a larger impact on prices, so they can't trade as much. So essentially, the informed trader tries to hide within the uninformed. An outcome of this model. Now, keep in mind, this was a very important model, but it was constructed in a simple world. So now we're taking this model and we're moving it into the real world, which, again, we break some of the assumptions of the model. We allow this market depth to change over time and so forth. But from this model, it started us on an area of a way to estimate and understand the changing market depth. And again, market depth meaning how much I can trade without pushing prices. So in this model, we have a parameter lambda measuring market depth, and specifically 1 divided by lambda measures the order flow in dollars necessary to increase or decrease the price by $1. So this is what we want to estimate. So we can estimate this. This is, so we have lambda here as the absolute value of the change in price divided by the volume in dollars. We can rearrange this and set up a regression equation. So the left-hand side, we have absolute value of the change in price. The right-hand side, the volume in dollars that it took to change the price by that amount. We estimate this, and we get our coefficient there, lambda. As an application of this, to show you this estimation in the real world, or I should say in research, there's a paper I did on Bridget there with Pratt. And what it did was, the idea of the paper was to look at Twitter's stock price and implied volatility and options around a fake news announcement. So we have a lot of research on how, on real news announcements, meaning like an acquisition. So how the market will react to that, how informed traders will trade, and how the market maker will react to those informed traders. But this, we identified an announcement that was fake. So we want to test if there's differences by which the market will react if this is not a genuine news announcement. And so the fake news announcement we identified was a false takeover bid for Twitter. And I believe this was on July 14th, 2015. So the idea of this is somebody set up a fake Bloomberg news website. And then on that website, had an article saying Twitter's going to be acquired, and if memory serves, they tweeted the link to that fake website, and so people saw it and they said, okay, Twitter's going to be acquired, and they start piling into Twitter stock. So again, this is all uninformed. This is not like a real takeover where there'll be informed traders. The idea of us identifying this is all these people piling in are uninformed. So what I do in this paper as part of the analysis is to estimate a Kalman filtered estimate of this lambda coefficient of this market depth. If you're not familiar with the Kalman filter, this is basically, we have this regression equation, but instead of that lambda being constant, it changes over time. And so the Kalman filter creates an optimal estimate of this coefficient over time. Kalman filtering is very interesting. It has its roots in control engineering. So, but what you can do in this assignment is you can maybe estimate a rolling regression and so forth. So we estimate this market depth, and we'll take a look at that. This is just the code that will create the chart that you're going to see next. So this is Twitter over the day of this fake news announcement. So let me widen it for the entire day. So yeah, this is July 14th, 2015. So again, we're estimating this market depth. So now what we have here is not 1 divided by lambda. It's actually 0.01 because I want to look at how much do I have to trade to move the stock price by 1 penny. So what this is saying is, given the coefficients, the market, the behavior of the market makers on this day, you would have to trade $15,000 worth of stock to move Twitter stock price by a penny. So you'd have to buy $15,000 worth to move it up by a penny, or sell $15 worth to move it down by a penny. So this gives us our estimate of the market depth. Now the idea here is we're looking at, well, market depth is fairly constant. Again, there's nothing happening in this market, so the market makers, their idea of the informed versus uninformed and so forth is constant. However, once this fake news comes out, the market makers, you can see this as uncertainty in the market makers. All of a sudden, they don't know what's happening, so it takes less. Now we're down to 13,000, so it only takes 13,000 to move it by a penny, and it roughly takes. It's a little bit lower, and this is probably about when we realize it's a fake news announcement. But then it jumps up to, you'd have to trade 20,000 to move it. So this is the market makers trying to get a handle on whether this is true, whether the people are informed. In other words, if I think all of a sudden people out there know something I don't know, obviously I widen my bid-ask spread and I become more sensitive to order flow, and that's what we're seeing. But this is a fake news announcement. So at some point they realize the news isn't fake. So anyone trading here is uninformed, and I don't really care I don't care about their trade. So it becomes less sensitive to order flow. And then once everything sinks in and everyone knows it's fake, it goes right back to where we were beforehand, about $15,000 to move Twitter stock price by a penny. So this is an application of using the method of estimating Kyle's lambda framed in our understanding of informed versus uninformed traders. So your assignment, to use this Twitter price data to calculate Kyle's lambda and interpret the value. Again, the important thing here is you can interpret what this means. Not that you can estimate it, but you can say, okay, 15,000 to move it by a penny. Then also estimate how stable Kyle's lambda is. What you can do here is use a rolling regression. You don't have to use a Kalman filter. This is just to get an idea. And again, I highly recommend any finance students to immediately, once you see a theory, get into the data and start estimating in any way you can the relationships. Now, what I have here is I have an IB account, part of the assignment to download data using an IB account. However, IEX now allows you to download minute data through their API for free. So, and what I'm going to do, what I've already done, is written a bunch of code to access the IEX. The IEX is the exchange. You might have read about them in Flash, the book. I think it was Flash Boys, Michael Lewis. You can now download this data from there, and I will probably do a presentation teaching you how to use the code I wrote or that wraps around the IEX API. So you don't need the IB account, and I'll post code for this soon. So this will be your assignment. The data, the Twitter data, I've put here, so you can just clicking this link, you can download the data in CSV format. You can also download it as an RDS file. This is an R compressed file, and it will, if you read in the XDS library, read in the data like this, then you'll have all the data already. XDS is a class for handling time series data. I'd recommend, if you're a finance student, Excel is very important, but also if you do this in R or Python, that is very useful. So I'd probably recommend doing it in R and Python, but if you want, you can also do it in Excel, and I'll briefly take a look at the data in Excel. So if you click here and open it up in a spreadsheet, you will see this right here. And then it is very simple to estimate this, our measure of market depth. All we have to do is say, okay, this is equal to the absolute value of the change in price. This will be the weighted average price here, and then we just need our estimate of how much was traded, or a calculation of how much was traded. There we go. We can copy that, paste that down. So this is 30-second data, so this is every 30 seconds. And then what we might want to do is create a rolling estimate of this value over the previous hour. So stock market opens at 9:30, so I'll go down to 10:30. Doesn't have to be exact, just roughly here. And I want not $1, but a penny. So I'm going to say, how much does it take to move this by a penny? So then I'll just use the slope here to get the coefficient. And There we go. Now I'll paste this down, and it should give me my rolling estimate. So it goes to K22, 23, 24, right? So now this has a rolling estimate. You can see it starts off low, but and this is roughly probably when the event was happening. And then we're back down to our stable, fairly stable estimates. So, and again, this is just a simple rolling regression. This is not an ideal way to do it. Better to use the Kalman filter, but this is a way you can start taking a look at the relationship, taking a look at the data, and charting it and what you will to just get you comfortable with estimating these values. Excellent. Lastly, now this isn't part of the assignment, but it's just for your understanding. And I think at least I found it interesting. You might find it interesting. This is a graphic I created for the publication. And what's happening here is this is Twitter stock price here in this blue. And this is the event, right? So it happened between roughly 11:30 and noon. So I can zoom in here and see this is when the website went up. And then there's a tweet from this open outcrier. And again, I think that link to the website. And what you can see here is once that tweet goes out, the stock price increases. Somebody else at CNBC picks it up. I think this is Carl Quintanilla, tweets on the takeover, right? So now it hits CNBC. So now you can think, this is public knowledge. And then noise traders jump in, uninformed basically, and start pumping the price up. And what's on here is on the right axis here. This is the price. So that applies to this colored line. I'm not sure what that is, what color, but this line is the right axis. Everything else is this left-hand axis, the implied vol. When I look at option prices, I look at the implied volatility. So now what happens here is first article that's hoax comes out. Bloomberg, Ty Trippett says the story is fake. So right here is when it hits Bloomberg that the story is fake, and then you can see the stock price falling from that point. So right back down to really where it was beforehand, $37. Now, what's going on here is we look at the option prices. So while the stock is going up, this is an option implied volatility. This isn't the option price. This is saying so the option price, call options, is going to increase given the stock is going up. But this is the amount by which, so this is implied volatility, how much that goes up during the event, which increases both call and put values. Meaning this is independent of the changes in the intrinsic value. So that's these other lines. So this is the implied volatility in put option maturity 717. So this is the implied volatility in those options across strikes, so across all the strike prices. And what you can see is this goes from about 45 up to about 75% annualized volatility. And you'll see a similar. So this is a call option, 717. The implied volatility goes from, again, 45 to 75. So what you see is during this event, again, if I knew this event was going to happen, I would be trading in these options rather than in the stock, because again, these call options, the intrinsic value is going up and the implied volatility is going up, and the use of leverage inherent in buying call options. So in our research, we were looking at the reaction of this implied volatility, which you see increasing dramatically. One interesting aspect of this that you can think to yourself, one thing you might be asking yourself here is, well, look at the implied volatility. For this blue one, that's a 717 puts. The implied volatility is 41. But over here, this purple one, this is puts with a maturity expiration date of 7/31, and even before the event, this has a implied volatility of 65%, and then these are less sensitive to the event. So again, the implied volatility, the sensitivity to the fake news event, is a function of its expiration date, and the later expiration dates have a much higher volatility and they're less sensitive. The options set to expire sooner have lower implied volatility and they're more sensitive. So one thing, again, this is not part of necessarily market depth, but if anyone has an idea, you can post in the comments of why this option has a higher volatility than these options here. Once you realize it, you'll know, and you can actually go back and check dates, so you'll be quite sure of yourself. But any idea why the 731 options have a volatility of implied volatility of 65%, where the 717s have 40%. A dramatic difference. Any ideas? Feel free to post it in the comments there. Excellent. So I hope that's a good brief introduction to how we understand the sensitivity of a stock's price to order flow, framed in uninformed versus framed in the goal of the market maker, to not lose so much to the informed trader, to make enough from the uninformed to cover any sort of losses to the informed traders, and some data to go in and start estimating this value. And again, I'll post some IEX code, some code around the IEX wrapper, some code around the IEX API, I should say, that will allow you to go in and start doing these calculations for any different stock. What you're going to find is if you go in and you do this, you go in, pull the data, and you start doing these calculations for Apple, it's going to take much more. And again, what you want to do is pull this data and then start estimating it and seeing if your estimates are consistent with what you think. So in other words, if I do this for Apple on any given day, I expect much more than $15,000 to move Apple stock. Right? Apple's a very large company. There's not, again, this is very also. There's a lot of analysis. There's a lot of eyes on Apple. So the proportion of the informed should be far less in Apple. So you're going to, I would expect much more than 15,000 to move Apple. However, if I were to look at a smaller stock, then I think it would be, there's less people willing to trade it. There's less people uninformed that are willing to post bids and asks and trade a smaller stock, and also the proportion of informed would probably be higher because it's a less watched stock. So the idea is you should see this market depth estimate change. Big well-known stocks should have greater market depth. Smaller unknown stocks should have less. So definitely dive into the data and see if your estimates are consistent with that. Excellent, and have a great afternoon.